Hi, I'm here to explain about the debt fund strategies and styles that most fund managers use while investing and creating portfolios. So broadly speaking, I will just start about what debt funds are. So debt funds basically are instruments which invests in government securities, corporate bonds, treasury bills, commercial papers, and you have varied maturity profiles, starting right from overnight to long duration bonds, banking and PSU bonds. Each of them have their own risk return metrics and yield and maturity periods. Now, there are broadly two strategies which fund managers use while creating portfolios in debt funds. One is the duration-based strategy, and one is the accrual-based strategy. Now, the duration-based strategy basically, works on the premise, and fund managers can use a combination of the two depending on the current interest rate scenario. Before we go further, in today's interest rate scenario, an accrual strategy works better than the duration strategy, and I'll explain why that is so. So the duration-based strategy works in such a way that if interest rates go down, then the bond yields go up. Yeah, so in the duration-based strategy, let's take an example. Say a bond with a face value of 1,000 and an interest payout of 8%, which is 80 rupees paid out annually. In a scenario where interest rates rise, the existing bondholders would not benefit because the newer rates or yields that are being offered are, say, 8.2 or 8.3%, whereas existing bondholders, are getting 8%, and therefore bond prices will fall. And when interest rates fall, existing bondholders benefit because the newer yields which are being offered today are lower than 8%, say 7.5 or 7.8%. And therefore, the existing bondholders benefit because they have been able to secure and fix a rate of interest at 8%, whereas the ongoing new rate is at 7.5%. And therefore, in a declining interest rate scenario, existing bondholders benefit, whereas in a rising interest rate scenario, existing bondholders tend to lose out. When it comes to new investors, in a declining interest rate scenario, obviously new investors will not benefit because they're going to be purchasing the bond at a lower yield, whereas the newer investors where interest rates rise will benefit because they're going to be purchasing bonds at a higher yield.